My name is JK, which stands for Jacqueline Kwok. I'm the head of platform for DCG, investor and operator in the Web3 space, and I'll pass it off to Jordi.
Hi guys, I'm Jordi, founder of Selini. We're a market maker, venture capital investor, and we also do a lot of poker stuff. So if you guys like poker, we have an event tonight. Let me know.
Hi everyone, my name is Charles. I'm the CEO of the dYdX Foundation. dYdX is an OG player into the perps decentralized exchange space, and yeah, we keep building in this amazing and highly competitive market.
Hi, I'm Pedro, founder of WalletConnect and director of the WalletConnect Foundation, the largest wallet network with more than 700 wallets across all chains.
I'm Xiao-Xiao, operating partner at KKR. KKR is the largest private investment firm in the world with 700 billion AUM. I'm lead the sort of tech private equity value creation as well as the digital asset strategy.
Amazing. So I've been also told that I should introduce more chaos to the questions. Okay, so I'm just gonna start winging it.
Okay.
Talk a little bit about the correlation between equities and crypto.
So yeah, that's definitely a chaotic correlation because sometimes it's 1-to-1 and it just feels like we're NASDAQ squared, and then other times, a few years ago, people started telling me that they have a sense that crypto is leading equities, and I was like, there's no way. It makes no sense. It was such a small market compared to such a big market. Completely dismissed it, and then it's actually happened several times now that you have to agree that sometimes crypto will be the forebearer of what happens to equities. It'll sell off first, and it'll recover first. We saw that even with the tariff tantrums, with a lot of other situations. So there's definitely some correlation. Hopefully we get a little bit of that gold spice on top because gold, has been doing very well, and that's sometimes positive, sometimes negative correlation.
Maybe to build on Jordi's comments here, I think for part of the market, crypto is probably where they feel like it's a safe harbor whenever they lose some degrees of trust or confidence into the equity market, playing the role of gold a little bit. But the equity market right now are on steroids, the crypto markets are on steroids as well. So it's probably not a good time, perfect time to do a full diagnosis.
Well, I think that conceptually, like, all equities wish they were like crypto, like that's their inspiration. But like from a liquidity perspective, it's actually the opposite. Like every crypto wish they were an equity from a liquidity perspective, but they all aspire to be as commoditized as possible.
I think when we talk about equity, I think we mean like public equity. There's obviously also private equity, right? Very different market and crypto. So I was actually just looking at before that in terms of market size, right? What are we actually talking about? Global public equity is roughly 130 trillion in terms of market cap. Private equity, including private credit, is around 25 trillion. So it's about 4 or 5 times smaller than global. Public equity in crypto, as we know, is like 3-4 trillion, right? I think one of the biggest differentiators is actually the level of institutional, ownership, right, of these markets. On the public equity markets, the majority is actually institutional. Like, some people say 50-60% is probably higher. Retail is probably 10-20% of that. Private equity, as you know, like retail has no access to private equity, so it's pretty much 100% institutional ownership. And crypto, as we know, right, started off completely 100% retail, and we're now just at the early innings of like institutional adoption. And I think that's probably one of the biggest drivers of like correlations of these different markets. Right now, crypto and private equity markets is not really correlated, but with global equity, I think the correlation, if I look at the correlation of Bitcoin versus S&P over the last 5 to 7 years, it's actually the longer term trend it's actually increasing, right? And there are like periods where it's like exactly opposite, as Jordi said. But the longer term, I think we can maybe discuss about that, like what is actually driving the longer term, like increasing correlation, and is that actually a sustainable trend? Because I do believe that crypto is starting to get into a phase where it's not just a high beta to kind of global equities anymore, and it's starting to develop its own sort of demand cycles. So maybe we can continue on that front.
Why do you think that is? Because you all had a slightly different answer in terms of like how you view the correlation between crypto and equities, private and public. What do you think is driving it?
I mean, obviously, liquidity is the number one thing that drives markets, and it comes in waves, it comes in cycles. I think sometimes the high beta-ness of crypto is what, just makes the liquidity being felt. Like when there's some extra liquidity, as we saw like after COVID, you just completely skyrocket. And then when the liquidity starts to drain, you're probably feeling in crypto faster. Now there's also this like alternative path going on with gold and Bitcoin as being a digital gold, which arguably is a little bit counter-cyclical to some extent. Like it can become more of a flight to safety, and equity sell-offs can actually do well in those categories. It's a bit of a mess right now. Obviously, the dollar is getting completely drained. And so you can see situations where prices are going up, but if you look at non-dollar currencies, it's not going up that much. It's such a multi-factor chaos. I'm glad you went here. It's chaos.
I think the infrastructure is also playing a role here.
What do you mean infrastructure?
I mean, access to equity is basically infrastructure to access equities is done everywhere. You can get access to American equity in Asia and vice versa. So there is no access, and the total amount of participants can be maximized on the equity side. On the crypto side, we are still in a little cocoon where we are in the industry because we know how to access, but the vast majority of the investors don't have access to those rails yet. So we've seen the big demand for crypto ETF, which is signaling that there is an appetite to go. But when it comes to accessing DeFi, for example, there is only a small subset of the potential participants which have access today. And this infrastructure is being built. There is more and more access via different like powerhouse of infrastructure or big market participants. But yeah, the infrastructure really play a role also here in how they differentiate, and this is going to rebalance faster than what we think.
I think when we say that like blockchain is really fast, like the most important thing for me is not the actual like explicit speed when you're actually interacting with it, but actually how organically it can change. Like that kind of dynamic is very hard to emulate in stock markets because of all the gatekeeping, the KYC, and all of the guardrails that exist. And then in a way, equities can really benefit from that speed, and they could amplify its growth much faster. But then crypto does not have the liquidity, and they're kind of like emulating each other, trying to get the best of both worlds, and eventually they will converge to just become one.
I think I mentioned institutional adoption being a driver, but for sure there's like some very big macro themes that are driving crypto adoption, right? Like I think deglobalization, I think debasement of fiat, right? Money printing, and then just like with this sort of like currency instability and deglobalization, right? There's like just less reliance on single sort of currency, single sort of assets, and you will have to hedge more. And I think that's sort of as the world goes into a more multipolar sort of geopolitical order. I think it's the same for financial assets, right? It's sort of like you need more hedges, you need more diversification, and I think that also drives some of that crypto adoption.
Let's switch gears and talk a little bit about risk, because as institutional participants come into the space, they often have a set way of looking at risk and a fixed risk budget, as one would say. Why would they increase allocation to a risky asset like crypto?
I mean, there's a lot of risk in missing the winners, right? We know that in venture capital, for example, it's just if you miss that one or two big winners in that cycle, it's a huge problem. And it just feels like now that the political alignment has happened in the US, it's very different than a couple of years ago. Now you don't really have a strong excuse like you did back then. You could just say, well, Gensler is shutting it all down, I can't invest. So now I feel like it's risky not to. If there is a catch-up trade between you know, the market caps of gold and public equities, then and you miss it, that seems extremely risky. So I would be terrified not having allocation to crypto as an institutional investor right now.
So as Xiao-Xiao for KKR, given that KKR I feel like is kind of newish in the crypto game.
Since 5 years.
5 years? Okay, not as new as I thought it would be. So as the main institutional investor in this panel, how do you think about it?
Yeah, look, I agree. Personally, I agree with Jordi and probably a lot of people here. That's why, otherwise I wouldn't be here, right? But still, it's actually surprising, right? How much ignorance I face, right? Like when I talk with just traditional financial investors, and the hubris that sometimes there is still in traditional financial markets. And I was really surprised when I looked at the market size, because everyone has this perception that private equity is like this 50-year-old, you know, they're dominating, you know, they own the biggest companies in the world, and they're like the masters of the universe. Everyone has watched a movie like Barbarians at the Gate. It was like KKR founders, like swashbuckling like 40 years ago, buying the biggest companies in the world with like a bunch of junk bonds. But if you really look at the, you know, a 50-year-old industry of private equity, right? In terms of private, so if you take away all of the private credit, which is a fundamentally different business, and private real estate, etc., private equity in terms of total market cap is around 6 trillion today. It's not that far off of total crypto. And crypto is like, I mean, as an industry, maybe 10 years old, right? And obviously the growth rate is much faster of like the crypto. I mean, there's like obviously corrections, etc. Private equity is like just a juggernaut that's just compounding like double digit, you know, year after year, which still makes it a very attractive sort of portfolio diversification tool, right? So if you talk to sort of like pension funds or sovereign wealth funds, the allocation, they have like buckets, right? Like the main bucket that they basically have for private equity is called alternatives, still until today, which is not bonds and not public equities. And that alternatives bucket has increased like dramatically over the last, I would say, like 3 decades, but it's still much smaller than bonds and public equities until today. And I think what's the interesting thing that is happening is that crypto, as an, you know, emerging institutional asset, is starting to get into the same bucket, which is called alternative. And you basically like allocators are looking at different ways to allocate between private equity, traditional hedge funds, some rates, right? And basically now crypto and maybe gold and that kind of stuff, right? And I think that is a fascinating thing, like, you know, to do. A lot of the bigger guys in the world, they don't have the need because they have been doing well. Double digit over like a few decades is a tremendous return, right? It's very difficult to replicate. But with the limited track record that crypto as an asset class has, obviously, if you look at over like, you know, 10 years, it's vastly outperformed on an annualized return basis, but you still have the 80%, 70% drawdowns every 4 years, which is a big problem, right, for institutional investors. But I think, you know, Charles, you mentioned about a few things. There's like quite a few things that we can basically literally define that need to be overcome, that a lot of people in the sector now are working on, so that you know, barrier can be overcome. But it probably also means that those crazy returns that crypto will have as it grows into a 5 trillion, 6 trillion, 8 trillion sort of asset class, you won't have these like 100% annualized returns anymore. You will go down.
Some of the allies we have in this mission of bringing more institutionals, I think they just show up a few months ago, is basically the CEOs of these DAT companies, the treasury companies. Think of the Tom Lee, think of the Joseph Lubin, think of Sam Tabar from Beat Digital. All these people have credits and they're legitimate into the world of private equities. They've got weekly programs on CNBC and all these financial networks. And I think they're going to really accelerate the adoptions of institutionals and making them invest in infrastructure or allocate more, because they're really very, very good spokespersons for our industry. So they show up lately. We have our own spokespersons in our industry, but they can reach only so far. And this kind of new cohort of ambassadors of crypto are very, very powerful.
I've noticed so much that for these institutional investors, the packaging matters more than what's inside. Like the packaging, if it's clean and it just looks like something that's easy to allocate to, it's a lot easier. So obviously, like something like a Circle stock is very much the packaging that they're used to, and they can just open the wrapper and it's what they're used to seeing. But you know, in the past, if they had to onboard fiat and switch it to Coinbase, I don't know, it was probably harder for them. I think now these days there's people have caught on in crypto, and we start appealing to the institutional types with things that they're used to seeing. Obviously, the DATs are a very controversial example of some of this stuff, and maybe it's not really the institutional people that are buying them, but it's just one example of how we're starting to bridge the two worlds by trying to make things look like what they're used to investing in. Obviously, venture was probably the first one. I mean, KKR, I imagine, was just viewing crypto companies as the same as they would view any kind of forward tech investment, and that was easy to put into that bucket, even though what's inside that bucket might be very similar to investing in Solana or something else. That was just something harder for them to do. And then of course we have CME and ETFs and all these like other pieces start to come. I think the good crypto founders are finding ways to make things appealing now. So it's not just Bitcoin, which is arguably just like a treasury asset, but some of the other assets as well.
It'll be funny to see what this panel would look like next year with DATs in the mix. Is it equity? Is it crypto? What's the correlation across all of those? We don't know. So I forget who, but one of you mentioned the regulatory side of things as digital assets mature. So crypto regulatory clarity is improving just as equity markets faces potential headwinds, but clearer regulations might reduce crypto speculative premium while increasing institutional adoption. Which of these do you think would dominate?
What's the reason why the speculative premium would go down? Because it's more regulated?
Yeah.
People
assume that's the hypothesis.
That's like, okay, if they legalize drugs, then people won't do drugs because it'll be like less cool because it's legal. Is that, I don't know what's going on in Portugal. Is that what happened? Did people do less drugs after? No?
Still cool.
Still very cool.
So I think we're okay on that side. I think it's just
I think the correlation is more like the more regulated you are, the more institutional money you have, and then the speculative premium comes after the fact. It's not because of the regulation, but because the regulation does drive the institutional money, and then the speculative premium does go down. But it's not because of regulation.
Yeah, look, I think whatever regulation you will sort of try to put into this space, you will always have this like radical bifurcation, right? Like you have on the one hand this barbell. I think that's just getting clearer and clearer. You have like the regulation, what it drives is that like hyper institutional players, have something like a wrapper that they can explain to their stakeholders, and that drives a certain type of, adoption and product market fit. But I think what makes this space, what is the underlying sort of like attractiveness and the energy of the space is always going to be on the unregulated like retail speculation, that fervor of like speculation, that just the promise of incredible returns is, and that sort of appeal to animal spirits is always going to be that, the what feeds the capitalistic instinct of like, people and institutions alike. And the innovation on the sort of DeFi side, I would say, is always going to be a step ahead of what regulators actually understand and will be able to regulate. And I think that will always be that cat and mouse race, right? Like, the innovator, the inventors, they will always come up with new structures, like, perps, where, Arthur invented that, right? Like it didn't exist in equity markets. And that just proved that there's just tremendous product market fit. And the regulators had to catch on, and they don't know what to deal with it because there's nothing alike like that. And I think new structures and products will keep coming out from this, crypto side. And but then it doesn't mean that there's no space for the institutions, right? Like you would still like normal pension, I do believe there's a place for Bitcoin in pension plans, right? And so I think that bifurcation will always be there.
Do you think it'll be a Bitcoin or a Bitcoin ETF?
Right now, Bitcoin ETF, maybe DATs. Bitcoin will be amazing because that will mean that industry has grown, to a degree where the sort of rails, like the custodians, the sort of, accounting and auditing side of things are mature enough for regulators to be comfortable to be put into pension plans. But regardless, it's still exposure to the same underlying asset.
Something which is adjacent to regulation, but also touching on the institutionals, what I noticed over the past quarters is from a media perspective and the way projects go to market, I think we've been migrating away from a PR market where will basically reach out to media and to your audience saying, I've got a new feature, I upgraded my protocol. And now we are kind of entering at very fast pace into an IR market, investors relationship. And we see more and more projects, and at dYdX, I lead this initiative at the foundation, where we spend time with dedicated content, dedicated calls, analyst calls, to basically speak to this audience and make them understand our protocol, make them understand the business model of the protocol. And we see that in all across the kind of asset class of crypto. I think Michael Saylor did a great work to educate the market on Bitcoin. We see the DATs doing that for Ethereum. But I see more and more projects also kind of broadcasting their business model and their value proposition to a new subset of the audience very precisely, which are the investors and the liquid funds and the allocator in general. And a few months back, no one was really talking about their tokens because of regulation, and maybe because also they were thinking, I need to speak to users, but now you need to speak to users, but also to your investors.
It's really funny you mentioned that, because I definitely feel that transition, and there's a lot of founders that I knew back from when I started crypto that did not have maybe the understanding that that's the world that we're going into. And most of companies in crypto had like strong DevRel teams. That was like one of the strongest things that you could have in your team. Is DevRel relationship was the most important thing. And as we're becoming more and more like capital markets and like heavy, like investor relationship is becoming one of the most important parts of the company. And that's something that what I always try to say is like equities will become more crypto and crypto will become more like equities. And essentially crypto is kind of like copying things that exist in traditional markets to attract that liquidity. And even WalletConnect token, we actually participated in this initiative by Blockworks, which is a token transparency report. And it basically just looks what your traditional like equities format, templating and everything. It's the same information that you would have gotten anywhere else, reading the documentation, the website, but just like in a more institutional packaging, like you said.
How is that being received in terms of having IR teams talking to investors? Do the investors understand the metrics that are being presented, the disclosures, the management discussions, and
you need to revamp your story because it's a different type of audience. So you really focus on the key metrics of the protocol, you focus on the P&L of the protocol, you focus on the valuation, you explain the total amount of tokens which are already being released on the market. You try to really mimic what a normal equity analyst will be looking for. And with this new kind of cohort of investors, with most probably a background in private equity, as Jordi says earlier, you need to make sure that the wrapper and the packaging of your project also becomes kind of readable and attractive to these new allocators.
Yeah, I think this is a very fundamental actually struggle that the crypto industry is actually facing, because equity markets fundamentally are valued on cash flows, right? Like you basically like put some kind of multiple on future cash flows. And crypto is not, right? Like crypto is all about network adoption and, hedge against fiat debasement and those kind of sort of type of attempts of valuation. But I think this year probably is the first year where you start to have like a, batch of companies like, I don't know, Hyperliquid, and it's like, perp dexes that actually produce material amount of sustainable sort of cash flows. How sustainable will still to be seen, but it's a fundamental struggle. And when I talk to like founders of DeFi protocols or perp dexes, they're stuck in between, because like, on the one hand side, you don't have to treat it as a security. On the other hand side, like we all like, yeah, if you try to like do like equity style IR on a perp dex, you basically admit it's a security, right? You basically say it represents cash flows. And that's not a given, right? Because that has tremendous regulatory, implications as well, right? Which I'm not sure you would want to admit. And I think it's this whole thing, like, do you want to value a DeFi protocol just on its cash flows, or is that actually undervaluing what it actually is? Like, I'd be very interested to hear your thoughts, right?
Well, I think the struggle is because we're trying to put it into existing buckets. Is crypto a commodity? Is crypto equity? It's actually both. Like, because it's a commodity because it's a pricing on a public resource. It's something that just exists natively on the internet, which is something like you would price like steel or silver or gold. But at the same time, it is almost a productive asset. Therefore, it does have a cash flow. Like gold would never generate a yield intrinsically, but Bitcoin can generate a yield intrinsically. So how can Bitcoin be both digital gold, but also be like an equity? That's exactly what crypto is. And that's why I say like equities, they wish they were crypto because they are the same benefits of being a commodity, but still being productive assets like equities.
I mean, I have a slightly different take. I think Bitcoin is a commodity. Clearly, it's sort of taken that role. I think Ethereum was trying to maybe be in that category. It's arguable what kind of mix it is. I've always called it community money in my sense. Like the strength of these L1 communities is what determines the value of their asset because it's cash flow, basically like insensitive. It's not really relevant to the cash flow. It's more like the network effect of what you're doing. And then everything else is actually a security. You just, we haven't officially termed it as such, but if you don't have a like outside of, the top majors, if you don't have a cash flow and there's no projection for a cash flow, then you're a casino table and that's fine. Like, meme coins have done well and people, when they go to the casino, they want to play these things. That's a limited size of that. I mean, the casino industry is big. I think it's like 50 billion a year or something, with sports betting, it's quite a bit higher. And so a lot of those things can continue to be speculative casino games. But for something like, Hyperliquid or Ethena or, anything else, at some point you need to have some projection of cash flow, even if it's in the future. Otherwise, I don't think you can call any of these things commodities, in my opinion.
I do hope they have cash flow in the future.
Hope so.
Okay, so speaking of cash flow, that means that there's some sort of crypto adoption. And crypto currently trades based on kind of speculative behaviors from market participants. So how do you think fundamental blockchain digital asset adoption can drive prices higher?
You've got multiple ways to kind of capture the value on your protocol, right? People do buybacks, people distribute staking rewards, people do a mix of that. People burn tokens. So depending on your risk appetite and the setup of your project, there is multiple ways to essentially capture this value and increase the price of the asset.
Yeah.
Well, I think buybacks are a little bit easier for most people to understand, but like buybacks are a very coordinated effort that usually requires like a central entity, like a foundation, accrues some revenue and then it uses that revenue to do buybacks, and therefore that drives the token value up. But most people, like maybe they're disillusioned now and they don't believe in utility tokens, but the utility of an utility token is that to access that resource, there would be continuous buyback, like organic buyback, in order to access that resource. So what the foundations are doing as these centralized buybacks could have happened in an organic way. Like that's something that we are trying to do, where we're trying to create the incentive such that multiple entities do buy back the token in order to access the resource, which is the WalletConnect network. And then it's not the foundation actually doing the buyback, but actually the foundation creating the incentive such that multiple parties do the buyback.
And maybe something controversial, because like if you come from the equities world, it's pretty crazy to be in an industry that is high growth and pretty early stage. And whereas some kind of consensus that protocols should buy back their own securities, which is the opposite of like growth, right? Like in equity, you have growth versus value, and only the value stocks which don't grow anymore and that produce a lot of cash flow, only there the investors are demanding some kind of like buybacks and dividends, etc. Right? Like growth stocks should retain their cash flow to grow the operating business. And I don't really understand like why like 1 year old like protocols where their stakeholders are like saying like, yeah, you need to buy back 99% of your like of your shares. That's pretty crazy to me. Like, I mean, I just see actually a lot more productive ways how that, you know, capital should and can be deployed, right? And for some reason, maybe, you know, tokens, because tokens are such an effective sort of bootstrapping and customer acquisition tool, somehow we got so like complacent about like, yeah, I mean, it's so efficient to acquire users organically with just, you know, doing airdrops and farming like some native tokens. But in the real world, like you need to spend cash to kind of acquire users, right? You need to spend cash to kind of like actually do R&D, and you need to acquire like patents, and you need to hire a lot of people. I think we live in this like bubble where like we want the best of both worlds. We want high growth and we want buybacks.
I mean, we've seen everything tried. I think the dividend meta, which we had a few years ago, didn't end up playing so well. Basically, like you tell people, just stake your asset and you'll get a dividend. I think what ended up happening is, you know, those dividends don't go back into the asset. The price, people are so sensitive on the price chart. And when you do buybacks versus dividends, you know, when you go to business school, you go to INSEAD, they tell you it's kind of the same thing. You do buybacks, dividends, but it's not the same thing. It's the same thing if you're a long-term holder. It's not the same thing if you're looking at the price chart. Looking at the price chart, you want buybacks because it makes the chart look good. Meanwhile, people are not gonna like remember when you go to CoinGecko that actually like I got a bunch of dividends in the meantime, and so I'm actually doing fine. We had you know, we had one of these perp dexes that was like, I think it was called Vertex. It was paying a bunch of dividends. We made a lot of money in dividend. The chart looked awful, and it kind of killed the momentum of the project. They eventually got acquired. I think buybacks are kind of a way to try to like correct the price chart because people overvalue that, and so, you know, we're in early innings. We're nowhere near this like proper way of thinking about, you know, should I take this revenue and do customer acquisition, or should I just put it into the chart? It's sort of a weird part where we're still like discovering what works and doesn't work. But I would say dividends less so. Buybacks, obviously, this cycle has proven to be like an effective mechanism. I agree with Pedro. Like utility tokens, if your product makes sense to have utility, like if it's like a BNB, or, you know, now like Bybit's trying to do this with Mantle, if you can start to have the actual token unlock some use on the protocol or do something, then that's great. You just have to figure out like how much of the token does it take. You know, do you need 100 of the tokens? And then if you need only 100, then why should you own 200? You only need 100 for the utility. It's sort of, we're figuring it out.
What we are trying to figure out as well as dYdX, 25% of the protocol fees go to buyback. Another percentage goes to staking validators and stakers. Another percentage goes to essentially distribution partners, so people who integrate with dYdX get additional revenues. So yeah, we're trying to find a balance. We're not going all in into buybacks or all in into one direction. I think eventually you want to find a balance. And there is also, from the audience around your asset and your protocol, there is different needs, right? Your distribution partner wants to get revenue share. Your token holders are happy to see the token price going up. So eventually, as Jordi says, everyone kind of navigates this, and we are trying as many others.
I did like what Jordi said about the price matters, because I've done this a couple of times. I go to a lot of conferences and we have a booth of WalletConnect, and our team is like behind a booth and talking to people. And sometimes I position myself behind the people who are actually talking to our team. And the number of times you see someone pulling their phone and checking the WalletConnect token price as they're talking to my team, like they're essentially judging them on whatever they're saying based on the token price. And I'm like just behind, just looking. I was like, this is such a common pattern. Like price is the best marketing.
I think when Jordi said, "I just put the money into the chart," that sort of exemplifies I guess the state we're in. I think it's actually one of the reasons why private equity was born, yeah, from the public equity markets. And Arthur was here in the morning. Arthur Hayes is building basically crypto private equity fund because it doesn't really exist in crypto, right? Maybe for good reasons. But for some of these, this is exactly why private equity was born, right? Because the focus on real-time pricing of the security, and then the relentless focus on short-term financials, which if you are publicly listed, whether it's crypto and equity, you are exposed to that, right? And private equity basically offers an alternative, which means just thinking in sort of 5-year investment cycles or 7-year investment cycles, where you can actually make longer term investment, like with very different ROI calculations, and not being forced to be judged on a real-time price chart, essentially, right? And no market makers in in the meantime to kind of like basically paint the chart, right?
Well, I really appreciate all of you guys' spicy takes. It was actually pretty funny. Well, unfortunately out of time, so thank you, esteemed panelists, for joining us.